Mark Cassari here. What is an IUL? Let me tell you. IUL stands for Indexed Universal Life Insurance Policy, and it's nothing more than a permanent life insurance policy. It was created in the late 70s. A guy named E.F. Hutton came up with the idea. He said, I love the stock market and I love the safety and security of life insurance. I want to bring the two together, and thus we have Indexed Universal Life Insurance. Now, there's a couple important things to know about the IULs. Number one, IULs have cash value growth. That means any premium that you put into the policy minus the cost of insurance goes into a savings portion of the policy. The savings earns compounding interest based on the performance of the market. When the market goes up, you earn. When the market goes down, you never lose because of something called a 0% floor. These types of policies guarantee you never lose because of market volatility. Number two, it has death benefits. Death benefits is used when you pass away. All that money will be transferred over to your beneficiary in the form of a death benefit. That death benefit is traditionally tax-free to the inheritor. And number three, it has something called living benefits. Living benefits is if you, the client, have a critical, chronic, or terminal illness, that death benefit or a portion of that death benefit will be paid out to you while you're alive, living and breathing, to take care of your life for the rest of your life. It's important to know that these types of IULs don't have any guarantees, but they do track the market. And traditionally, the stock market has done around 10% on an annual basis over the last 30 years if you look at the S&P 500. Now, there are caps with some strategies, which means if the carrier sets a cap to 10% and the stock market earns you 12, you're going to capture 10% in your policy and the carrier will get the remainder. Now, the right way to design these policies is with minimum death benefits and maximum cash value. That allows your cash value growth not to be hindered by a high cost of insurance. These policies are not meant for high death benefits. So when you sit with an individual, make sure that they're telling you the truth and they design it for minimum DB and maximum CV.